As I said earlier, this idea about this being the year where a lot of the investment we've seen in the IT space really translates into growth for some of those companies suggests that there will be some pretty exciting growing businesses as well that will do quite well. But you can already see in performance year to date a fairly sizable shift from growth to value and from large cap to small cap in terms of performance. So we think the US economy is reasonably strong. We think there is a lot of political support and financial support coming, and there is, for the first time in a number of years, an interesting opportunity outside the very large cap technology companies at the top of the market, with a lot of the laggards or companies that have been left behind for the last few years starting to see some support and starting to see some interest from the wider investment base. So we think that this will be another good year for US equities. The growth rates are looking extremely attractive. Valuations outside of the very largest companies are towards the middle of the range where they have been historically. So it looks like it'll be another good year for the US, but with a broadening out of where that performance comes from outside of the companies that have been leading the market for the last number of years. Yeah, there's been a very volatile start to the year in the markets. There are a number of issues and threats and opportunities that have emerged this year already. And I think some of those relate to the Trump administration, and some of them are more widespread in the economy in general. I'd say the areas where we're most optimistic and looking towards continue to be select parts of the technology and AI wave. I think this is really going to be the year the rubber meets the road in terms of delivering on growth for a number of companies that have invested quite heavily. And some of those we think are really going to have very good years. At the same time, there's a big risk that's started to arise around displacement and disintermediation from a lot of traditionally very strong IT businesses that are starting to see their business models come under a bit more threat from some of these tools. So that is one area we continue to think is going to be very relevant this year in terms of driving market narrative. Outside of that, as I mentioned previously, there's a lot of hope this year that the market at the low end of the consumer base particularly is going to see a re-acceleration. For a number of years now, we've seen this K-shaped economy that people call it, where the top part of the consumer base has continued to do very well and spend and be particularly healthy, where the bottom half of the consumption base have lagged and have struggled a lot more, with quite a lot of fiscal support coming this year. Things like stimulus checks that are being mooted by the Trump administration is a very, very real scenario that those consumers that have struggled for the last few years will accelerate and start to see a lot more healthy spending environment for that. And that really gives an opportunity to a whole part of the market that has been left behind in terms of performance in the stock market over the last 3 or 4 years. Yeah, the US performance of the last decade or two has really been based upon superior corporate earnings and corporate growth rates compared to other parts of the world. So it's not been without basis that the US has been the market that most people have wanted to invest in and the market that's led the world in terms of performance. Going forward this year, we don't see any material change to that. There has been, I should say, a very heavy reliance on a handful of companies to deliver that growth the last few years. But the results that we're seeing this year so far suggest that that growth in the other parts of the market is starting to accelerate very quickly and catch up to where the tech leadership has been the last few years. A lot of that makes sense when you think about where we were 12 months ago. So with tariffs coming and a lot of barriers being raised by the Trump administration that hit a large part of the market quite hard. We've now had 12 months of that where these companies have got their arms around some of these headwinds and charges that they face and have managed to mitigate some of them in lots of cases. So we're seeing faster growth now pick up from the 493 other companies in the market that aren't the Magnificent Seven. And that is coming through very, very clearly in corporate results so far this year. Yeah, I think that's a very good question. It's very, very relevant right now. When we look at the whole market, the average valuation for a US business is still very much where it has been for many, many years. It's not elevated at all. When we look at the market cap weighted valuation of the index, it's extremely high relative to history. And what that's telling you is that the very largest companies that have performed so well for the last 3 or 4 years have become quite expensive relative to everything else in the market. So at this point in time, particularly with what we're seeing with regards to the amount of investment that those companies are making, it has felt to us like the opportunities are best somewhere lower down the market cap spectrum. So in the mid-cap and small-cap areas in particular, and outside of the information technology space is where the most attractive opportunities look like they lie. I think that will definitely be supportive to that rotation, but I don't think it'll necessarily be as simple as growth to value. I think there are a lot of really exciting businesses outside of the top 10 that are growing very, very quickly, and the market will still continue to reward those. And as I said earlier, this idea about this being the year where a lot of the investment we've seen in the IT space really translates into growth for some of those companies suggests that there will be some pretty exciting growing businesses as well that will do quite well. But you can already see in performance year to date a fairly sizable shift from growth to value and from large cap to small cap in terms of performance. We try to be a little bit different about how we approach this. We try to be a lot more bottom up about how the areas we allocate our clients' capital to. If you ask me which sectors I think look the most attractive right now, I would say it's very clearly tilted into 2 areas. Firstly, what we would term quality. So those companies that are perhaps a little bit more defensive, a little bit less cyclical in how they generate their earnings. There is a lot of excitement in the market about a cyclical acceleration, and that has meant that a lot of these companies that aren't necessarily exposed to that have lagged the market the last 6 months. Lots of those companies are very attractively valued, growing extremely nicely, and there's no reason they won't perform very well over time. This is just not their moment in the sun. Alongside that, there are some very interesting stock-specific opportunities in areas like healthcare and real estate, where we've spent 12, 18 months with a lot of political headwinds, a lot of very large scare cases around things like pharmaceutical pricing and funding more generally in the US space that have put a lot of these companies in the doghouse, dragged their valuations down to extremely low levels, and some of those headwinds are now starting to pass. And we can see, a handful of really exciting businesses that are trading at multi-year lows, and they all seem to be correlated and located in the healthcare sector. So those would be the 2 areas I'd really kind of call out that look the most attractive to us right now. Yes, yeah, good question. I mean, lots of people think of the US market and think that dividends aren't relevant, but actually they make up, a very, very large part of return over most time periods. So the US does have less of its total return come from dividend compared to Europe or Asia, but over the last 5, 10, 25 years, 40 to 50% still comes from the income side. So it's still very relevant to a long-term investor to think about the dividend and think about the growth rate of it, because it does comprise a very large part of your return over the long term. The way we think about trying to invest with this tailwind or take advantage of that is to look for businesses that grow their distribution over time, funded out of becoming bigger businesses themselves. So if you can find a business that grows and returns an increasing amount of cash to shareholders every single year, that provides a really powerful tailwind to the share price as well. If you think about a share price that doesn't move for a few years, but the dividend keeps growing, at some point that dividend alone starts to look very attractive to an investor, draws investors in and starts to push the share price up alongside it. So we know there's a very powerful and consistent tailwind behind this strategy over time, and it has to be based upon companies that are growing. So finding these companies isn't always as easy as just clicking your fingers and looking for high dividend yields. You have to do a lot of work, a lot of combing through opportunities, talking to companies, finding about their growth opportunities in front of them. But once you can do that, if you can build a basket of these companies that outgrow the market, grow the dividend alongside it, you get a very, very attractive dynamic around valuation and return. Right now, what we've just been discussing about the health of the US economy is a really nice market environment to be looking for these sorts of businesses, because there's a lot of income growth coming out of the US still. The fund that I manage has been growing its distribution at double-digit rates for the last 2, 3, 4 years now. And we see no reason why that won't continue. And so clients that have been invested with us along this journey have received a very, very nice income stream to go along with capital growth as well. So we look for these businesses that we think can grow for a number of years, and we also have the commitment to grow the distribution, the dividend alongside that. What we're looking for in practice tends to be a little bit higher quality than the rest of the market, as you would expect with a dividend fund. We look for businesses that are a bit more robust, a bit more mature, have very good returns on capital. Where we differentiate ourselves, I think, from some of our peer dividend funds and from the market in general, is we're looking for companies that have the ability to grow at those returns on capital for a number of years. So we're looking for businesses that have the ability to invest in themselves, grow their business alongside paying us cash flows as dividends as investors. So that is a very nice balance between growth and dividend return that provides an incredibly powerful tailwind to what we're trying to do. It's quite stock specific. We would usually have a 40 to 50 holding portfolio, and within that we'll have an incredibly nice and varied spread of companies. Another fantastic attribute of the US stock market is there are hundreds and hundreds and hundreds of companies that have good dividend track records, that are growing very nicely and rewarding shareholders with a growing income stream. That allows me as a fund manager to always be able to follow where we think the best opportunities are, build a very balanced portfolio, and really give our clients access to what we think the best opportunities in the wider market are, while still retaining that tailwind and that performance boost from a growing income stream. Yeah, I think the market has been extremely narrowly led the last 12, 24 months or so. A lot of our best performing companies have been in the technology side, as you would expect. We've done extremely well on the fund, as how a lot of people have, by investing in the hardware companies that are supporting the AI investment cycle. So a company like Broadcom, for example, has been one that we've owned for over a decade now. That has become incredibly well regarded and has been a fantastic performer in the wider market. They've taken advantage of a huge opportunity to grow that's come from the increased capital expenditures of companies like Alphabet, Microsoft, Amazon, and so forth. But outside of that, there's been a second leg to this performance with other ancillary parts of the IT market. So another company that we've held for about 12 months or so now is Seagate. It's a hard disk drive company that's seen a huge amount of growth and really changed what was a sluggish and sleepy industry into a more attractive, high growth market. A lot of their products are used in data centers to store the data that is used to drive AI models. And so they've seen a huge amount of demand growth for their products appear in the last year or two. Those have been the areas we've actually taken capital out of the last 12 months or so. We think a lot of valuations in that space have gotten quite elevated now. As we discussed earlier, you know, there's been an enormous amount of performance generated from the IT sector the last 2 years or so, but this part of the market is now starting to look very, very highly valued relative to other opportunities. And so we've been taking money from those areas and putting it into a range of companies across a whole different variety of end markets. We're seeing, as I said, a lot of opportunity in the more high quality space that's been perhaps a little bit left behind. So one of the more recent additions we've made on the fund is Abbott. It's a medical technology company. It's had a pretty static or steady share price for the last couple of years, whilst the growth of the business has been particularly attractive. The valuation is at a discount to market, is very steady, very stable. It sells into a lot of end markets that are pretty attractive. That is an example of a business that we've taken the view that the growth rate hasn't really changed. People have deemed it unexciting in the near term because it doesn't have a lot of cyclical talk to it. But this is a company that has delivered a fantastic amount of growth historically. We think will continue to grow very nicely. The dividend is a very nice premium to market and grows at double-digit rates as well. So if you can get these sorts of collections of businesses that will yield 20, 30, 40, 50% more than the market and grow faster than the market, there's only a certain amount of time that people can ignore that dynamic about cash return to you as an investor. And so we have been finding, many, many opportunities like that outside of the top end of the market that we've been reinvesting into.